In the early 1950s, a struggling writer and single mother lived on welfare in a small apartment in Edinburgh, Scotland. Now, she had virtually nothing to her name. No job, no money, and she was battling depression while raising her daughter alone. But she did have one asset, an idea for a story that came to her during a delayed train journey. And for the next 7 years, she wrote whenever she could find time. And this often was in local cafes, while her daughter slept beside her, using an old manual typewriter. And when she finally completed her manuscript, she faced another daunting obstacle. Her novel was rejected by 12 different publishing houses, one after another. Now, most people would have given up at this point, but this determined writer kept pushing forward, and finally, a small London publishing house agreed to print her book, but with a modest initial run of just 1,000 copies, and even advised her to get a day job, suggesting she would never make a living from children's books. But the publisher failed to recognize that the shifting landscape of children's literature and entertainment. Now, while most of the industry experts focused on simplified, shorter books for children, this writer saw an opportunity for longer, more complex stories that really respected young readers' intelligence and imagination. Now, her instinct proved remarkable, and the book became a sensation, first in the United Kingdom and then all around the world. Now, what began as a seemingly hopeless endeavor eventually grew into a multimedia empire worth billions. And it spanned 7 novels, blockbuster films, theme parks, merchandising. But what's most impressive here about this story is how the author's greatest success came from recognizing a gap in the market that others had overlooked. Now, she studied the landscape, she identified the emerging opportunities, and positioned her work perfectly to capitalize on it. The market shifts we're seeing today remind me of this story. Now, what looks like an obstacle, the end of American exceptionalism in the stock market and some of our economy, might actually be pointing us towards a remarkable new opportunity if we're willing to adapt our perspective. Let's dive into today and some of the investment landscape that we're seeing and the significant shifts that are reshaping how we should approach our portfolios in the coming months. If we rewind just 3 to 4 months ago, in late 2024, the prevailing narrative in financial media was crystal clear that the US stock market was the only game in town, and they called it TINA. There is no alternative. And this dominated the investment thinking, and honestly, the data supported it. You see, from late 2022 through early 2025, the MSCI World Index rose about 45%, while the ex-US index, so the index without the US in it, rose about only 28%. So then going back even further to 2018, we really see the dramatic changes. You see 61% of the gains for the MSCI World Index versus just 3% if we didn't include the US. So yes, the US stock market didn't just outperform, it was in a league completely on its own. And this was a very simple time because we had multiple expansion, we had all things that were happening here in the US with our earnings. But since 2025, the world index earnings grew by 80%, including the US. But if we exclude it, it was only 40%. Now, when we dig deeper into these numbers, we find that the income for the technology companies, the communication sector, it grew by 180% over the past just 12 years. And with 50 percentage points of that coming in just the last about 24 months. So you can see there's a lot going on here. But what did drive this exceptional growth? Well, there are two primary factors. First, it was a massive capital expenditure from what we call the Magnificent Seven. And these are the tech companies, and then we obviously add in a couple others as well there. But what was happening is that they were hyper-scaling. They were ramping up their costs and their quarterly expenditures to about $40 billion in the middle of 2023. But then that increased even more to $70 billion by the end of 2024. So this is a staggering number, and it was mostly directed towards, well, you guessed it, AI, artificial intelligence, and all the infrastructure there. But then the second element, US households, and then also some foreign investors really wanted to buy more stocks. And they wanted to do that dramatically so as well. And they wanted to do that dramatically. And they wanted to own a higher percentage of stocks. And so that caused some of the assets to surge from about 25% all the way up to 43% ownership. So yes, the US financial assets were being held by foreigners as well as us here in the US. And we saw all of these equities jump in price. Now that was a huge deal. And when we take a look at all the different elements here, we now can see what's happening as we're moving into 2025. Because the pillars that were supporting all this American exceptionalism began facing serious headwinds now. And for the first time, AI capital expenditures, well, yes, we have the long run thesis, all the different trajectories, it remains promising, but even so, what's happening now is that all the expense that we're doing for AI is really going to be hard to compare year over year. So what we're facing now is the steepest comparative period ever, and emergence of lower cost models like DeepSeek is really putting pressure on all the margins. So that will change things. Second, the government is reducing its spending. So we've accelerated dramatically from 2022 into 2023. The federal government was spending an incredible amount, but that started to change in 2024, and we started to decelerate how much we were spending. And now, for the first 3 quarters of 2025 is what we're forecasting. This will even continue more, that we're going to lower the amount of spending, and that's going to create some drag on our economic growth. The third element then, immigration. You see, that was driving labor force growth really over the course of the last couple decades, and it happened dramatically. From 2000 all the way through 2021, we had a lot of immigration happening, and we had about 1 million people per year coming into the United States. Now, I'm not here to talk about all the different elements of that, but we did have a lot of people coming in. And then that also jumped to 2.7 million in 2022, 3 million or more, actually a little bit in 2023 and 2024. So these numbers were huge because it helped with some of the jobs that were out there and filling some of those jobs that were really needed. But that also boosted housing demand. It lowered, actually moderated some of our labor costs, and it supported our income growth. So there's a lot here with how immigration happened. But those were the boom periods. And now foreign-born employment, it grew by 3.5 million, while native-born employment actually declined by 200,000. And that's just from January 2025. But now net immigration has declined, and this is an approximation between 80 and 90% according to some of our estimates here. So here's what's happening. The US has entered 2025 facing a very real challenge in what we call rate of change. Now, this is even before factoring in all of the trade tensions, tariffs, and all the different concerns that are out there. So there's a lot that's going on right now that's really stoking just changes in our economy. But here's where the story gets interesting. We are now facing headwinds through at least about third quarter of this year. Regions are starting to show that there's some promising areas as well, like Europe, they're starting to see the facts that after years of their economic stagflation, they're really starting to benefit from modest growth and having the reacceleration that's happening there. So with that, they're having to increase some of their spending with the government, especially on defense spending. And that's what's happening with Germany right now. You see, they're really going back to signaling that they're going to be bullish with their stock market and their economy. But here's the key takeaway that I really want you to know. That yes, right now, we have a little less confidence in the US just because of some of these headwinds over the next couple of months. But when we have some alternatives, we don't have to think about Tina, that there is no alternative, because now there is. And that's where we take a look at, yes, being a part of the US, being a part of our own macro economy here. But we can also make some transitions to a more favorable place as well. And when we are looking for differences of what we're projecting for not only this year, but next year, we can see a lot of this really shaping up well. And that helps us to successfully navigate these markets today, recognizing that the data is choppy and that over the next coming months, our fundamentals, all these cross currents, everything that we're seeing is really complicated. And so when we take a look at all of this, and especially some of the change, there's a lot here that we can be looking to. And there are some great growth opportunities. So gold has been one that has been a great growth opportunity since, well, about fourth quarter of last year. And yes, in the first 2 months of this year, it has jumped significantly in price. And then April 2nd happened. And we're now obviously on this side of tariffs and some of the things that have happened, but that's all causing us to have a potential record-breaking numbers, I should say, for gold increasing in price. But we see some of the consumer demand pulling forward as well. And when we take a look at some of the earnings reports from some of the banks, including what we've just recently seen from Capital One, the April's uptick year over year for all of the consumer spending and everything we're seeing is not there in the same way. And so while we're seeing gold be a great place to be, others still aren't. And when we talk about the consumer and the anticipated tariffs, yes, even Redbook retail sales, they have surged a little bit just because the possibility of a pull forward of some of these purchases. It really does suggest that March and April data may be distorted in that the consumer behavior is temporary, especially if we get some price hikes. So when we come to May and June and some of these outsized drops in consumption, that's where we don't think we're going to have as good of a time with our stock market. So that would mean that we don't be as heavily invested into some of those areas. But this volatility is something that happens. And yes, it can be challenging, especially in the near term, but we think long term as well. So that's what we can be looking for as part of your portfolio. And here are some principles that I wanted to share with you to help guide you through this. First, that we can be confused by all of these different investment strategies and what's working and what's not. Let's look at what we call the signal and the strength of that signal. That's how we find great opportunities. So we were talking about Europe just a little bit ago, and a lot of countries and companies there are showing that they have some great signal strength. Gold has also been one that has been showing that signal strength as well, and it's really actually a hedge against uncertainty, especially what's going on with tariffs, trade policies, and the like. So use the signals and the strength to your benefit here. Secondly, then, reduce the investments that you have in what we call high beta assets. So this is ones that have higher risk associated with them. And when we have a slowing economy or we have the uncertainty of the markets, they can be very choppy. And it's time to reduce them as we're able. Because as companies sour in maybe their projections, especially after the recent bull market, that may actually cause them to fall a little bit further with some of these challenging economic times. Well, third then, and perhaps the most important thing to remember here, is that you want to be turning your savings and your investing into millions of dollars. Well, that means not losing. So reducing your downside risk is actually quite critical here in this environment. You see, we want to preserve your wealth, and that's the primary focus here. If we navigate through this period of time, then we can come out on the other side ready to invest and to continue moving forward. So remember that we really want to be protection minded too, especially when volatility is very high. Now, that's a lot of information today, and I want to return to that story. Remember that our struggling single mother in Edinburgh that faced rejection after rejection from publishers? She didn't give up on her vision. She recognized the market opportunity that others had missed and her instincts, and it ultimately created one of the most valuable, entertaining franchises in the world. That determined writer was J.K. Rowling. And the Harry Potter series went on to sell over 500 million copies worldwide. It has changed children's publishing forever. Well, today's markets really do present us with some similar inflection points. Could it be the end of American exceptionalism? Probably not. But it's something that there's a lot of fear-mongering out there. And this can actually be a great opportunity for you. Not only with some great US companies, but also to reallocate and discover new pockets of growth and new positions that you can take advantage of. So just as J.K. Rowling found extraordinary success in what initially looked like a hopeless endeavor, you can turn this into a tremendous opportunity in the markets as well, if you're willing to adapt your perspective. Look at the signals rather than the crowd, and remember, protect what you have so that you can be growing as well. With that, I know that there's been a lot here, so please, if you found this helpful, please hit the like button below so that you can help others find us. Subscribe to our channel so that you can find more insights, and as we post new content, you will be the first one to know. Now, with this complex environment that we're in, all of these different trends that are happening, all the different things with your financial situation, please feel free to reach out to us. We'd be happy to schedule a complimentary review of your portfolio. Think of it as a second opinion or a stress test. We'd be happy to do that. So please feel free to reach out. You can email us or get in touch with us, and our information is in the comment section below. And because of everything that's going on, with all the changes that are happening, I have hand selected this video for you to watch next.